How does the securitization process use rating agencies? Imagine turning a bunch of loans or mortgages into a package that investors can buy. That's what securitization is all about. But how do investors know if these packages are safe? That's where rating agencies come in. When financial institutions create these securities, they group together assets like home loans or car loans into a trust. This trust then issues different layers of securities called tranches. Each tranche has a different level of risk and priority for getting paid back. The senior tranches are paid first and usually get the highest credit ratings. The junior tranches absorb losses first and tend to have lower ratings. Rating agencies step in to analyze this entire setup. They look at the quality of the assets in the pool and how the tranches are structured. Based on their analysis, they assign credit ratings to each tranche. These ratings can range from AAA, which means very safe, to lower grades that indicate higher risk. The ratings help investors understand how risky each security is, so they can decide where to put their money. The role of rating agencies became especially important in the late 1900s and early 2000s. Governments and regulators recognized their ratings as official indicators of security quality. Financial institutions relied heavily on these ratings to decide which securities to buy or sell. This made the ratings very influential in the market. Thanks to these assessments, complex products like residential mortgage-backed securities and collateralized debt obligations could be sold to big investors like pension funds and hedge funds. Investors depended on the ratings to judge whether these securities were worth the risk. However, there have been challenges with this system. Since rating agencies are paid by the issuers of the securities, conflicts of interest sometimes occurred. This led to some securities being rated higher than they should have been, especially before the financial crisis of 2007 to 2000. Many securities were downgraded sharply when the true level of risk became clear, causing big losses. In the end, rating agencies are key players in the securitization process. They provide the risk scores that help structure the securities and guide investor decisions. Their ratings shape how these financial products are created, bought, and sold, influencing markets worldwide.